markets bounced back strongly after another one-day sell-off led by options expiry. Rates vol market suggests Jackson Hole may be another non-event. And industrial commodities ripped back higher after a China dead cat bounce and signs that US Delta variant may be peaking. All this and more in this week's Macro Insight. Welcome back, everyone, to Macro Insight. Today is the 24th of August, and let's talk about these markets. Okay, so, as we kind of started to see a pattern now, every expiry, right? We had a market that gets kind of stuck and pinned towards some big strikes. You kind of think that there's reasons why the market probably should move post-expiry when that gamma goes away. And it seems like we're getting people front running that move, and you're getting a bit of a move just before expiry or on the day of expiry. Everyone's getting bared up, and then that move gets unwound, right? We've had that happen a few times now, right? It happened last month, it's happened again this month. So if I bring up the S&P chart, drawn this little diagram off the chart here, right? So we had our break of the vol trigger, right? So the vol trigger last week, based on where the gamma concentration was around 44.20. We tested that, we rebounded, we then broke it. Looks like all hell broke loose. We got to lows of 43.50, and then we squeezed back higher, basically, right? And we even started to squeeze before expiry. Expiry was here at around 4,400. And then we went on to rally into the close in the US. And then we've gone on to rally again over, on Monday. Okay. I'd say I do think it was a bit of front running going on in terms of people getting quite short and bared up, given what was going on in China. And the fact the S&P hadn't really moved in sympathy with what was looking like a bit of a global growth rollover, with a lot of these restrictions popping up in China, ports being closed, COVID being a bit rampant in Asia. But then you had a few things to ease that at the end of last week, right? So you had the Fed, you had Powell saying that the pandemic is still very much with us and continues to cast a shadow on economic activity. And that kind of led the market to think that aggressive tightening on policy is unlikely. And it's also conditional on this Delta variant not being too bad and restrictions, not going into lockdowns and things like that. Okay. And the price action also post some of the weaker PMIs that we got yesterday kind of gives us more confidence that, the market's basically saying that bad data is good data, tapering might be delayed, or it might be smaller than we think. And also the inflation drivers like used car prices and airfares have started to normalize, right? So you've got a fair amount of ammunition. The Fed's been talking about tapering, but you've got a lot of ammunition there for the Fed to say, you know what, we're not quite there yet, right? And the market's cottoning onto that and kind of finding some relief from that we're not just going to go, foot to the floor on tapering, basically, even if we do get a taper announcement, which is unlikely now in Jackson Hole, it looks like, but maybe the Fed FOMC in September. Yeah. So if we take a little look at what the VIX did, obviously a big spike on the VIX, even though if you think about what the S&P did, we only went to 43.50, which is about a 100-point sell-off. VIX went absolutely berserk, right? I mean, it went from the lows of the range to the top of the range in like a day. Yeah. So I was saying last week that I thought the VIX had bottomed out again around that 15 area. It was on the way back up, kind of got that right. But then we basically touched as high as nearly 25. Within 2 days, we're slammed straight back down to the 16 handle. All right. So now I didn't take profit on any of my VIX. That was one of those blink and you miss it type rallies in the VIX. But my sort of view on the VIX was not own it as a trade and flip out of it in 2 days. It was more, I structurally believe that the September contract was going to hold some premium due to the fact that it contains the Fed FOMC in that window. And therefore it was a good risk reward owning that vol. And, you know, for me, it was like a bit of protection against other things. So I didn't really need to flip out of it, even though it did get up towards 23, which was a decent spike, right? Had it have kind of stabilized up there and, you know, made me think about, do I want to take profit and I had a chance, then maybe I would have done. But given the speed of that sell-off, I didn't take any off on that, right? But anyway, VIX got hammered. That kind of, you know, that happens a lot, right? When VIX pops like that, a lot of vol players are basically just sitting there waiting for VIX spikes to sell into. And when the VIX does go there, once they think the move's overdone, they come and slap it. Also, you have a lot of systematic vol sellers coming on the day of expiry, even like usually it's the week of expiry, gets a fair amount of selling flow, but even on the day of expiry, often you get some sellers of vol coming out of the woodwork for the next expiry. That kind of helps give the street a little bit more vol supply, and that triggers that move down in vol. So that's what we had. It's been obviously a good summer trade being short vol, and the market gave you a spike to sell into, and some people took advantage of that opportunity. As I've said, I think the September contract on the VIX are going to hold a bit of premium, as the FOMC is more likely to be your taper event rather than Jackson Hole. But I basically think, you know, bleeding too much carry over the next couple of weeks is dangerous, right? So, you know, it doesn't look too sensible to be piling into a load of vanilla options, straddles, strangles, anything like that, because they are most likely just going to bleed. And we've already moved back up towards an area where gamma concentration for the next month is looking reasonably high, according to the spot gamma guys. So, you know, we're kind of back in that. Didn't take us long to get back into that sort of state, right? If you are a protection buyer and you want to use this rally as a way of getting some protection on, put spreads are really the only sensible option right now. They'll keep your carry down by selling that expensive put on the downside, and it will allow you to just kind of have some protection that carries reasonably well. Yeah. And then, you know, if we look at the sector sort of decomposition, what happened last week, we've got no major surprise in that sort of weakness. We saw cyclicals underperform. So healthcare and tech outperformed as the kind of more defensive side of the market. And then you had energy and mining took the biggest hit, with mining down about 8%, energy down about 6 or 7, but they did both recover pretty strongly yesterday. So reflexive bounce there in some of those most beaten up areas. But that's kind of how the sector sort of dispersion has been. Yeah. But, you know, you've just had this massive outperformance of the likes of defensive, right, for a while now, right? And that's kind of signaling that the market was getting more nervous on growth and wanted to tilt their longs towards the more defensive sectors. And I don't really think that dynamic has changed, right? I think whilst the bond market is still signaling potential headwinds for growth, you're going to have that kind of sector kind of outlook for equity players. Basically, you're going to be more comfortable parking out in tech, utilities, and healthcare, and are going to be a little bit more wary about the likes of energy, mining, industrials, things like that. Yeah. And then, you know, what is going to kind of, much of that weakness last week was obviously attributed to the COVID Delta variant concerns across the world. But, you know, if you look at the US, there are definitely signs that might be peaking. So if we bring up this chart here, it was in Bloomberg, US Delta. So we look at this, it's got kind of cases, phase 1, phase 2, phase 3, right? So Arizona, Missouri as phase 1, they were the first to get the Delta variant. Then you got Florida, and that looks to have peaked on the 13th. And then we're basically saying the rest of the US, which is the blue curve, likely already peaked or will peak within the next couple of weeks, right? So that's kind of what those curves are suggesting. So, you know, if Delta is kind of priced into some of these cyclicals, then opportunistically getting into some of those trades in protected ways, I would suggest. You probably don't want to just be outright long, but, you know, using call spread structures and things like that for some of those more cyclical areas of the market could make sense. You know, I already suggested, you know, as a bit of a high octane play, maybe you want to look at those airline ETFs to see if there's some opportunity in that. That did overshoot through the 22 level, but has had a reasonable bounce as well yesterday. Yeah. China, as we know, has been an area of weakness, but, they reacted pretty quickly to their outbreaks in terms of their zero COVID policy they seem to have, curbing domestic travel, closing tourist sites, shutting their ports, so that they've gone hell for leather there. So that, whilst causing disruptions in the short term, hopefully would be short-lived because they're so aggressive about it. So, we got a bit of maybe an inflationary shock due to supply disruptions again, but that should be temporary. Certainly we hope it will be. And then you've got other parts of Asia, right, where COVID's been pretty bad, where the vaccine take-up has massively accelerated. So if you look at Japan, Malaysia, and the Philippines, their vaccine take-up in the last sort of month has gone up dramatically in terms of doses administered. Like, we're talking 10, 20x type numbers. So that's likely to kind of lead to an easing of restrictions across Asia in the next couple of months, I would say. And then on that China sort of front as well, you had quite a decent bounce in China tech, right? So, that K-Web ETF or the Hang Seng Tech Index, bouncing pretty dramatically off the lows, around 6-7%. Does that mean China sell-off's over? Hard to say. Again, it's a pretty strong dead cat bounce. I'm not rushing into it just because I think the regulatory issues are just impossible to kind of call. But, for the brave, it might be a short-term trading opportunity. Yeah. Now, some of the more sort of shrewd macro commentators that I follow, like Darius Dale over at 42 Macro, they think Goldilocks is the scenario we're in, right, for asset markets. They see decelerating growth and inflation, but only modestly. And they back tested that as a regime, and they think asset markets can continue rallying in that sort of state, right? If we had a sharp slowdown in growth, might be different, but that's not what he's envisaging, and that's not what his models are telling him. So he thinks we're in a Goldilocks scenario. Probably a big reason for that belief is sentiment. So if you look at some of the sentiment indicators and positioning indicators, here we have, sorry, let me just expand that. So you got Goldman's have a sentiment indicator showing that things are very neutral, if not slightly more bearish in terms of positioning, being light. You've got Bank of America's bull bear indicator, very mid-rangey as well. So nothing looking frothy in terms of sentiment. And that would suggest that a large liquidation event or correction in like the 10% sort of area, those magnitude, is looking fairly unlikely from these type of sentiment readings, right? There just seem to be too many bears or cautious investors out there right now. Yeah, and that price action that we saw post expiry, where no real, you had a bit of a bounce out of China, right? But nothing too dramatic in terms of news flow, bullish news flow, and we're getting these kind of extreme sort of squeeze type price action. That just goes to show you that positioning is a bit light, right? And then, do we think Jackson Hole is going to matter, right? So I would say probably the main gauge for whether that is going to matter should probably be what the rates vol market is saying, seeing as it's a rates event, right? And if we look at the move index, where that is versus its recent history, it's not really showing us any signs of being elevated, right? So given that the move has barely moved, right? I think Jackson Hole is basically much more likely to be a non-event, right, than we first thought. Now, like I said, the VIX collapse that we saw into expiry and the front end vols in the S&P coming off do suggest that equities kind of woken up to that idea that Jackson Hole isn't really an event. So, whilst I think there'll be a premium maybe for the Fed FOMC, which will keep the VIX September contract elevated, that might be the play, right, where you own that contract as your implied vol long, thinking that's going to hold some event risk, and then you sell shorter dated kind of September expiry, which is just before the Fed FOMC. I think Fed FOMC is the week after September listed expiry. You can maybe earn some theta by being short S&P puts in September, but you can own the implied vol part by owning September VIX contracts, right? And that might be a way of kind of having that protection, having some confidence that VIX future probably isn't just going to collapse because of that event, but be able to earn some theta in the meantime, basically, right? So as a bit of a relative value trade where you are long implied vol, but you're short realized vol, right? So that's something that I haven't put it on yet myself. I am already long a little bit of VIX anyway in September, but it's something that I'm looking at basically. And if I get confidence that we're going to be back to that kind of pinned state, maybe we'll wait for Jackson Hole, given that Jackson Hole is this week, right? And just in case something silly happens, or if we get a dip on Jackson Hole, maybe, then that'll give you ammunition to maybe sell some puts against the VIX long, something like that. And as well as the tapering timeline kind of falling in that September, October area, we've got seasonality, right? Favoring higher vols over the next couple of months. So if you look at the seasonality of what tends to happen over the course of a year, we tend to get this uptick in volatility around about that September, October time, right? So that again is supportive maybe to the idea of owning implied vol, but not necessarily realized vol. Yeah. Okay. So those are kind of my thoughts in terms of equities. Okay, in terms of the macro this week, nothing too game-changing, I don't think. You've got German IFO Wednesday, US durable goods as well. We've got Eurozone meeting minutes on Thursday, Jackson Hole starting on Thursday, but Fed Powell doesn't speak till Friday. And you've got PCE inflation in the US and Michigan sentiment on Friday as well. So those are the main macro highlights to look out for. If we look at what happened in FX and what is happening in FX, we did have that little push up above 93.50 on the DXY, but met with pretty quick selling. So you could argue it's a bit of a false breakout in DXY there. Didn't really manage to hold above those levels. It's gone back into the range there, back to 93. Obviously, 10-year yields have kind of found some stability too. They hit the top of that sort of downtrend, pulled back, and then they've just kind of sat there, not really done anything, right? So ahead of Jackson Hole, we've basically just had some stability in the 10-year, and vols aren't really pricing in any major move either, right? CTA positioning has apparently gone a bit long, right? So 1 year Z score in CTA positioning on US Treasuries is basically looking quite stretched. So obviously they've been following the bond rally and they've got longer and longer, just following the price momentum. That's how CTAs work. So that might mean that yields are susceptible to a bit of a pushback up, if you do get a bit more hawkish rhetoric out of Jackson Hole. But the likelihood is until the Fed FOMC, this kind of 115 to 140 area is going to be fairly hard to break, most likely in the 10-year yield, right? If we then go back to some of the other FX pairs, euro dollar, obviously strong bounce off that 116.5 area, which has kind of been a support if you go back to last year. I think what this does is going to depend a bit on, relative bond yields and things like that, right? The bond yields have gone quite low, right? -50 they are roughly. And, you look at relative value between bonds and stuff. I mean, if you're going to sell bonds, surely you should be selling European bonds rather than selling US Treasuries, right? So if that mentality does come into the market, then maybe bond yields creep a bit higher relative to US, and that would be maybe favor euro continuing its bounce, basically, right? So I'll be looking at that yield differential to give me some read on what euro is going to do, basically, right? But dollar seems to have kind of failed at that 93.5 level yet again. And the pound had a good bounce off that 136 area as well. So both those major pairs having bounces off pretty key levels. For now, no reason to kind of argue that bounce is going to hold, right? So yeah, that's kind of FX. In terms of commodities, pretty crazy moves, wild moves last week. Look at oil. really breaking down on the Delta fears, particularly what was going on with China. So, we had really key supports down at that 63 area, 62.60 I had. That overshot small, but it kind of held, right? So held off that key support. I managed to pick some up at 63, as I flagged in the chat, in the trader spreadsheet. Decent bounce, right? Back towards kind of 67. I'm going to probably put a trailing stop on my purchase at 63 to flip that out. If it breaks back below 65, I'll probably take profit on that clip. I'd obviously been long since 67.5, so just use that 63 area to kind of average into my long, and that's kind of how I'm playing it. Not really sure if oil's out of the woods yet, to be honest. Really you'd like to see a move, conclusively back above that kind of 68 area to kind of think oil's out of the woods. So I think it's early days. So I like oil from a long-term fundamental perspective, but I'm well cognizant of the fact that oil is quite a high vol, and if it wants to correct, it can have quite deep correction. So I'm not going to just sit there lazily hanging on to my long. I'm going to trade around my long. I'm going to use those fierce sort of down drops as ways to pick up exposure, and then job around that exposure and keep some minimum amount of exposure. So if the rally does just keep going, then I've got some, basically. That's kind of how I'm trading around that long oil position. Yeah. Like I said, fundamental backdrop's good. China obviously and the stronger dollar were dragging the whole commodity complex down. That weighed on it. But it's got good catch-up potential, right? If you look at where oil is relative to things like the S&P or whatever, and I'm not saying S&P is really a good reflection of macro anymore, but it's just there's quite a big kind of disconnect there. And you would expect OPEC to probably come in if the oil sell-off does start to get out of control and we start to dip below 60, then I'd expect OPEC to start making noises, basically, right? So the only thing is, the market's not as tight as it was. There's evidence of a glut of super tankers that are competing to ship Middle Eastern oil around, and that needs to be addressed before we're going to see a materially higher move in oil. Yeah. So that's kind of where I'm thinking on oil. In terms of gold, had a nice rally yesterday as well. So, that's jury's out still, right? I mean, 1830 was that big area that we couldn't get our heads above before. Now gold, we know it's disconnected from real yields, still got a lot of catching up to do versus real yields. Whether it manages to do that or not remains to be seen. But, right now that 1830 area has been a formidable resistance area. And until we get above that, hard to really get overly bullish about gold. If you do like gold or you do like metals, then silver's probably providing a bit more value in the short term. That did overshoot to the downside, got to some major supports around 23, and that's held. Before that precious metal sell-off, we were more in that 26 area. So arguably, you've got $2 of upside in silver, which could easily happen in the short term if we do continue to see precious going higher, right? So there's probably more value there. And then finally, if we look at copper, that had a move, pretty dramatic sell-off last week down towards the 200-day, kind of held the 200-day. If you look at sort of daily close, bounced pretty strongly off that 200-day area. Also, that I had some Fibonacci confluence zones. Didn't get to my lower one at 385 where I would have probably picked some up, but kind of broke that low fours, but strong bounce back to 420. Those who've been following me for a while will know that I love copper longer term, but I was expecting weakness in the short term. Hadn't really managed to play it because I got stopped out on my short-term shorts, but longer term, love the story. It's going to depend a bit on what China does in the short term. If China weakness persists, if they keep going into these really extreme lockdowns and things, and it's not short-lived, then copper will likely see some more weakness. But from a longer term perspective, if you haven't already bought your long-term copper exposures, that was a great opportunity to do it last week, or some of it last week, right? So, that's kind of what I'm thinking on commodities. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.